Okay, the last one for adjusting for deferred expenses relates to depreciation. Remember that when assets or excuse me, when you purchase equipment or buildings, they're initially recorded as assets, and that's because they have future usefulness. We haven't used them yet. And you will expense them as you use them, because as you use them, they help you to generate revenues. So you will have revenues, and then what you do each accounting period is match the expense of using these long-term assets as they help you to generate these revenues. So we have par for the course has two carts. They paid a total of $12,000. So $12,000 was originally recorded as an asset. What we have to now do is expense part of this. How much needs to be expensed depends on how long management thinks they're going to use these carts, how long they think they're going to benefit from it. Well, in this example, it tells us that they're going to use the carts for 4 years or 48 months. So the amount of depreciation to record for the month of May is calculated by taking your cost of the carts, 12,000, divided by the total time, which is 4 years. But remember, we're doing monthly financial statements, so we have to multiply that by 1/12 to get 1 month's use of these carts. Excuse me. All right, so the entry we're going to record, if you recall from earlier, is we debit depreciation expense and we credit accumulated depreciation. We don't credit the equipment account directly because this is just an estimate. Remember, we set up this contra asset account. So let's continue where we post the entry. So the amount of usefulness used of these carts is 250. We credit accumulated depreciation to get 1,000. Now that accumulated depreciation, notice again, it's a contra asset account. All your other assets have debit balances, at least the ones that we've been introduced to so far. The accumulated depreciation is reducing assets. And honestly, these two really go hand in hand. You'd almost, if it weren't for the accounting rules, we'd be reducing the equipment account. So when you look at these together, this credit balance is in essence reducing the equipment indirectly. So now if you look at the accumulated depreciation, it has $1,000 in it. It accumulates. It represents the total amount of usefulness that has been used since those carts were purchased. So the net book value, the amount of usefulness left, is your equipment minus the accumulated depreciation. And then again, that's the amount of usefulness left.